I think we're going to go ahead and get started. I want to welcome everyone to Understanding Financial Ratios. We have Ramesh Advani, which is one of our great SCORE Boston mentors. This presentation is also being sponsored by the East Cambridge Savings Bank, and we have them here, a few representatives here today to join us and help answer any questions that you may have around how the bank and financial ratios are important, what they're looking for, those types of things. But as we get going, I want to just talk quickly about SCORE in case you are not familiar. There's three main things that SCORE does. One is the sharing of information, which can come in the form of business templates and resources. All that information you can find on our website at score.org. I strongly encourage you to take a gander through there. There's all kinds of information. It's not just business plan templates. There's cash flow templates, marketing templates, all kinds of different things that I think you'll find helpful. The other thing we do is the training, and we are continuing our webinars and workshops through about mid-December. We have some great topics still that before the holiday season gets in full swing, and then we'll be starting back up again about the second week of January. The most important thing that SCORE does is the mentoring, and it is free and confidential. You can use that QR code to ask for a mentor. Our mentors are volunteers that come to us with a lot of different backgrounds and experience, and they want to share with the small business community. We work with folks that are trying to decide if small business ownership is right for them. We're working with those that are in that planning phase, and we are working with those that already have a business. Different things come up along the way, and we're here to help. The first session is going to be a get to know you. They want to know what your goals are, what your challenges are, and they will help work with you to come up with a plan. Oftentimes our mentors will even work as teams, or they'll bring in other mentors to help co-mentor, just to make sure that all the issues that you need addressing are taken care of. Getting a mentor is very easy. As I said, you can use that QR code, or you can just go to the score.org website. There's a blue box where you can put in your zip code, and that will match you to the chapter nearest you. It'll then ask you a couple questions, and that's the information the chapter will use to help match you to the mentor that can help you the best. We will be using the Q&A button today. We do expect a fair amount of people today, and we want to keep track of questions. We will stop periodically and answer questions that are related to what was just discussed. And anything else we will be saving for the end. So if you have questions for the presenter or for the bank, please put those into Q&A, and everything else we can interact through chat, no problem. We are recording. You can go to the score.org/Boston website, and you can find under local workshops, you can find previously recorded webinars. Give me about 24 to 48 hours to get that posted. So I'm going to go ahead and let Ramesh share his screen. And while he's doing that, I'm going to introduce Robert Nichols from the East Cambridge Savings Bank, and he's going to tell us a little bit about himself and the bank.
Thank you, Teresa. And thank you, everyone, for joining the webinar this afternoon. It's nice to be back with SCORE. SCORE has been a great partner to work with, and we continue and are willing to provide these outstanding workshops. East Cambridge Savings Bank is a mutual savings bank. We are not a publicly traded company, and we do not have investors. Mutual savings banks have been around since the early 19th century and are still quite common in New England. Our bank was founded in 1854 and has been operating with the same name and charter since then. Also, we have never been acquired or sold to a larger bank. Now, since East Cambridge Savings Bank is a mutual bank and does not have shareholders, we reinvest profits locally through mortgages, loans for small businesses, and supporting nonprofit organizations. Thank you, and back to you, Teresa.
Thanks, Robert. And Robert and Seth will be sticking around in case you have any questions that are geared towards the bank. Otherwise, I'm going to go ahead and introduce Ramesh, and it's all yours, Ramesh.
Thank you, Teresa, and thank you, Robert and Seth, and all of you who are here. Really appreciate you taking the time. I don't know the profile of any of the participants, the attendees, but I am going to presume either you are a business owner in the New England area, or you are a senior manager who is responsible for the profitability and success of the business and are interested in this topic. So let me get started. I'm going to not rush through anything, but I will pause and take questions. And if you use the Q&A button, Teresa will be moderating it, and then she will read out the question for me, and hopefully we'll be able to answer all your questions. There is no such thing as a bad question or a dumb question. All questions are good questions. So I'm going to go. Why is this not going to let me go down a slide?
You may just have to click back on the screen. And it should let you scroll after that.
Let's stop sharing. All right, it did it. The page down button on my keyboard didn't work, but my mouse worked, so that's good. So I'm going to first give you a brief introduction to ratios. And I have to tell you that I've been involved in the business world all my career, and numbers tend to intimidate people. But if there is one thing, if you own your own business, there are some basic principles of numbers that you should understand and be able to look into the business more. These things called ratios are mere markers in the road. They are not something that are cast in concrete, but it's worth you looking into. I'm going to talk about 4 different types of ratios: liquidity ratios, operating ratios, profitability ratios, and working capital ratios. And so let me get going. I'm going to start off by talking about 4 questions that I want to answer. What are financial ratios? Financial ratios are simply markers, as I just said, on your journey to making lots of money and being successful in meeting the needs of the marketplace. And why look at ratios? Numbers have been around ever since businesses have existed. And what ratios are simply pointers that tell you how you're doing today versus yesterday. And I'll define today and yesterday more when we look at some ratios. So it's important to know, are you doing better or worse or staying unchanged? And it also gives you a chance to decide what you're going to tweak in your business in order to improve what you're doing. So that's the reason why you want to look at ratios. What are the documents that you will need in order to calculate the ratios that I'm going to talk about? There are basically only 2 documents which you can get from your accountant or from your financial system. One is your balance sheet, and the other is your profit and loss statement. The balance sheet is something which is a point in time snapshot of your assets and liabilities. And generally, you can run your balance sheet if you're using an online financial system. You can click a button and run a balance sheet for any time that you want to. And I would suggest that if you don't get regular balance sheets to look at from your accountant, then you should at least make sure that your accountant gives you a balance sheet once a quarter, and also at the end of your fiscal year, which if your fiscal year ends in December, you're soon going to come up to a time when you will be able to, once they close the books, you'll be able to look at the balance sheet. The second document you need is a profit and loss statement. Profit and loss statements also can be run anytime. A profit and loss statement is not a point-in-time report. It is for a period of time. So you can get a P&L for a month or for a quarter or for a year. So what you need to do is, in order to calculate these financial ratios, you should get a balance sheet and a P&L for the exact same time frame. So for example, let's say you're going to calculate these ratios for the first time after this webinar. I would say sometime in January, after the books have been closed by your accountant, you should get a balance sheet for the year that ended in December 23, and also get a balance sheet for the year that ended in December 22. So you get two balance sheets, and then you also get two P&Ls. You get the profit and loss statement for the fiscal year 23 and the profit and loss statement for the fiscal year 22. So going down the road, you can always look, once you've calculated sort of a baseline set of ratios, you can then look at things every quarter if you like, or every 6 months, whatever time frame you want to use, and that makes sense. So that's how often, and I think if you use Excel, or you can actually, your financial system you use, for example, if you use QuickBooks, you should be able to, they might have the capabilities, you'll have the capabilities for having those ratios calculated for you. So it's one thing to do a calculation of a ratio, another thing to look at it and then decide what is it that you want to use from that information to dive into your business performance to understand what is causing the ratios to be what they are. So before I get started into specific ratios and overwhelm all of you, any questions on any of these points that I have just made?
There are no questions posted at this time.
Great. So I'll go on and I'll start with the ratios. As I said, we are going to talk about liquidity, operating profitability, and working capital ratios. Let's start with the liquidity ratios. What do liquidity ratios do? They help you understand if you can meet your short-term obligations using cash or cash-like assets. So everybody knows what cash is, and you'll have your cash information available on your balance sheet. Cash-like assets are if your business on your balance sheet has got items that can be quickly converted into cash. Like, for example, if your business owns shares or securities of other companies, well, you can always sell those shares, that stock, and generate cash if you need cash. Another set of cash-like assets are your inventories. So if you are a manufacturer or a merchandise place, you carry inventories, and inventories can be liquidated pretty quickly. Another form of assets that are cash-like are some things that we call accounts receivable on your balance sheet. What is an accounts receivable? When you sell any of your products on credit, then the cash has not come to you, but when they pay you, pay your invoices, your customers, that accounts receivable gets converted into cash. So those are some cash-like assets. So if you understand your liquidity ratios, tells you how you can avoid bankruptcy or default. Now, bankers like Bob and Seth and analysts and creditors, they look at two ratios, which are very important. One is called the current ratio, and the other is the quick test ratio. It's also called the acid test ratio. So what are these two ratios? The current ratio is you look at your current assets on your balance sheet and you divide them by your current liabilities. Now, this term current assets and current liabilities refers to assets and liabilities that are less than 1 year old. So assets that are currently on your books and liabilities that come due to the people you owe these liabilities in less than 12 months. So if you divide your current assets by the current liabilities, that number is called a current ratio. The general target, which we always recommend to businesses, you should try to make sure that your current ratio is greater than 1.5 or 2 or even greater, which says that you have a lot more current assets than liabilities. If the number is less than 1, that means you have a lot more liabilities than your current assets and you're not solvent. That's the current ratio. The other liquidity ratio is the quick test ratio. In the quick test ratio, you look at your current assets on your balance sheet, and in that number, you also have inventories. If you remove the inventories from your current assets number and then divide the result by the current liabilities, that's called a quick test ratio. And this quick test ratio, you should try to make sure it is greater than 1.5 or greater than 1. So it's very simple to calculate. You just look at your balance sheet. And when I told you for the first time you calculate, get the balance sheet that you have at the end of 23, get the balance sheet that you had at the end of 22, and calculate out your current ratio and the quick test ratio for both those years. So you can see, has your current ratio gotten better? Has it stayed unchanged or has it gotten worse? And similarly to your quick test ratio. So those are the 2 liquidity ratios you should try to keep in mind. Any questions on these 2 ratios? And they're not ratos, as my PowerPoint says, no ratos.
Yeah, there are no questions right now. I'm sure as we go, we may have a few more, but.
Yeah, okay, great. Thank you, Teresa. Okay, the next set of ratios are the operating ratios. This gives you a chance to look at how well are your operations running, your business. So the first one is the operating profit percent ratio. And the way you calculate this is you go to your P&L, your profit and loss statement, and you calculate this as a percentage. You take the profit that you have, which is on your P&L, before taxes or any other income that you may have, which is not from operations. So for example, if you've lent money to somebody and they are paying you interest, that's not resulting from the operations. So if you divide your sales dollars that you have, net sales dollars, you divide your profit, the sales dollars into your profit, you get a percentage, and you'll get an idea of what your profit percent ratio is. I mean, if, and there is no set answer to what that should be at any point in time. It could be 10%, it could be 30%, it could be 40%, could be anything. So I don't have a number to tell you what you should look for. But the best way to look for what this ratio is telling you, compare the profit percent ratio last year versus this year, or last quarter versus this quarter. And you can get a sense, are you getting better? Are you getting worse, etc.? And when you look at this percent, it'll help you determine, drive pricing strategies, for example. Obviously, with price increases, every dollar translates into a dollar of sales. Of course, assuming you're not going to lose market share because you've got a price increase. The other area is cost reductions. You could identify improvements in your profit percent by undertaking cost reductions that you could make in your costs, in your manufacturing costs, or in your selling costs or administrative costs, etc. So that's the first operating ratio that you should consider looking at. The second one is the inventory turnover ratio. Basically, this is a ratio, is a number that tells you how often in a year your inventory gets depleted or gets replenished. So inventory turns ratio of 4, for example, tells you that every 3 months your inventory is moving. Of course, the higher the number of the inventory turns ratio, the better it is. However, if it's too high a turnover compared to, and now this is an interesting concept that I'm bringing here, is you should know what is going on in your marketplace with the competition, in your industry, in your geographical area. Now, you could be a business that sells online, it's all e-business. So of course your competition could be from anywhere. If you have too high an inventory turnover, you could be missing sales opportunities. And how do you calculate inventory turnover ratio? You take your average inventory dollars, and I'll tell you how you get that, and you divide that by your annual cost of goods. On your P&L, you will find your cost of goods sold. So when you look at your P&L for, say, 2023, you will see what was your cost of goods sold in 2023, the annual number. And in order to find the average inventory, you take the starting inventory, which is whatever your inventory was at the start of the year. You take the inventory that was at the end of the year, and you take an average of the two, take those dollars and divide it by your annual cost of goods sold. That's your inventory turnover ratio. So operating percent, profit percent, and your inventory turns ratio. Those are the two operating ratios. Any questions?
I did have a question pop up right at the beginning of operating ratio, so I think it's referring to the liquidity ratio.
Okay.
Can you explain once again what that helps with, the liquidity ratio?
Yeah, sure. So the liquidity ratios are ratios that are calculated from information on your balance sheet. And both those ratios really give you a sense of how solvent your business is, which means how much money is available, cash is available. It's not enough to just say, okay, I've got this much cash in the bank, because while you have the cash in the bank, you also have certain liabilities. Like, for example, you might have payroll liabilities, you might have a current portion of a loan that might be coming due in less than 12 months. So these liquidity ratios determine how solvent you are. And it also gives a clue, an indicator to a banker or to someone who you might be going to borrow money. It'll also give a clue to investors if you have somebody who you might be approaching for them to invest in your business.
Okay.
Hope
I
that
do have,
helps.
yeah, I have 2 questions on the operational ratio.
Sure.
Okay, where could one look to get a sense of what is a reasonable inventory turnover ratio is? And I guess how does one best benchmark themselves?
That's a very good question. So there are many ways of doing this. What you have to do, and of course, I'm happy at some other stage if you want to just set up time with me in SCORE, and I could help you. I could look at your statements with you and tell you what to do, but you can also do this on your own, and you have to learn how to do a lot of this stuff also on your own. So first of all, be very clear, you know your industry, which industry you're in, and different industries have different historical information. For example, if you look at on the internet, certainly Dr. Google will be happy to give you, tell me what are the inventory ratios in, I'm making this up, in the retail merchandising clothing industry or something. But you can also go and look at public companies that are traded whose profit and loss and balance sheet are published, or look up this information. They also report it when they report their results to the SEC. For they're required to do that. You can just calculate this out and compare yourself, whoever you think is a good benchmark to compare yourself with. The size of the company also matters. I'm sure you know who your competitors are, and you could look up what they do and how good they are, how bad they are.
Okay, I have two questions that are very similar, so I'm going to kind of smush them together a little bit.
Okay.
Does the inventory turnover ratio, is it relevant to a consultant? Can it be used in the service industry? Is labor considered inventory?
Labor is not inventory, and it would not be, inventory is only when you have physical objects, materials, work in process, finished goods, etc. I don't know the consultant reference. What is is this something that a consultant could use to do what?
Is it applicable to somebody who does a service? So you kind of answered that. So, okay,
Yeah.
yep, that's it then.
Okay, great. All right. So liquidity ratios, operating ratios, the next set of ratios, one of the operating ratios that I referred to, actually, this is another way of looking at just profitability. So in your P&L, you have at the top line is sales, then there is a cost of goods sold, and then further down is the net operating profit percent. You should always make sure you're looking at the net profit operating percent. However, to give you a more direct idea of what's going on with your products, there is a ratio called the gross profit margin. And the gross profit margin is very simple. It's the net sales minus the cost of goods sold divided by your total revenue. And it's simply a percentage or the margin, and this should be stable or increasing over time, not declining. And over what time? It should be increasing over time, over a year, 2 years, 3 years. And if it is stable, that's fine. However, you have to be careful. If it's stable for too long, eventually it'll be declining, which clearly is a sign that your products are losing their impact in the marketplace. Net profit margin is just one step below that, which is the earnings after taxes. Now, remember, I talked in the previous slide about operating profit percent ratio, which is the percent of sales dollars that result in profit. So before taxes or miscellaneous income. But the bottom line that goes to your shareholders and to you is the net profit margin, which is on your P&L. You will see the earnings after taxes. And if you divide that by total revenue, that's the net profit margin. Just like the gross profit margin, if your net profit margin declines year over year, or whatever the net profit margin is for your industry, that's a problem. And what this will be is a marker for you to look at your costs and your management effectiveness. Do you have too much overhead? No, too many costs, et cetera, et cetera. That's what the net profit margin will tell you. And the third profitability ratio is the return on assets. And the return on assets measures how much profit is generated from each dollar of asset that is invested in the business. How many dollars does it take to get $1 of profit? And the way you calculate it is you take your net income from your P&L and you divide that by the average assets for the period. Just like average inventory, average assets are the assets at the beginning and the average assets at the end of the time frame divided by 2, that gives you the average. And if you divide the net income by the average assets, you get the ROA. Generally, manufacturing businesses have a lower ROA compared to service businesses. So it's always important when you calculate things like this that you compare your ratios for your own industry or your own business, your own marketplace. Those are the profitability ratios. 2 liquidity ratios, 2 operating ratios, 3 profitability ratios. Any questions?
I do not currently have any submitted questions.
Okay, great. And then the final set are the working capital ratios. What is working capital? On your balance sheet, you have assets and liabilities. And your assets are divided up into 2 large buckets, working capital and fixed capital. Fixed capital are things like your buildings, your equipment, your machinery, your land, etc., etc. Working capital is things that you need in order to run your business, like inventory, your receivables, etc. So there are 2 ratios to look at. The gross working capital, which is very simple, one number minus another number. You take your current assets, subtract your current liabilities, that's your gross working capital. The more working capital you have, the less you'll have to borrow if you need cash to manage your business. And of course, you know, every business has ebbs and flows during a working year. And so there are times when you are flush with cash, other times when you need cash. So you may have to get a temporary rollover cash needs. So if you stay on top of your gross working capital, you will know when your working capital needs your current liabilities are higher than your current assets, and you may need to borrow, even if it's temporary borrowing that you then return later on, 2-3 months later. That's fine, but you should know what your gross working capital is. This is an important number to just stay on top of in your management. The more longer term ratio that you should look at is your debt to your net worth. So debt, everybody knows what debt means, what you borrowed on your, and it's on your balance sheet. Net worth is what is it that your business is worth, so that when, if for example, you were to shut down the business or sell your business or cash in from your business, this net worth is what matters more than anything else. And another word for net worth is shareholders' equity. And there might be just you as the shareholder, or there could be a bunch of owners or whatever. So if you take your total liabilities, which are on your balance sheet, and divide it by your shareholders' equity, you'll get your debt to net worth. If your debt ratio is lower than 1 or 1.5, that is fine. Actually, it'd be nice if it was lower than 1. A higher ratio indicates that you are running your business relying a lot on borrowing, which means that there's not much equity in your business. So when you're trying to sell the business or get out of business, out of the business or whatever, nobody might be willing to pay for it. You know, they might not see value in the business. So I think those are all my slides. I will pause and see if there are any questions or any comments from anybody, or if Bob or Seth, you want to talk about what are some of the things you look at when you're looking at companies' financials or ratios?
Yeah, definitely. We can give Robert and Seth the opportunity. I do have a couple questions. Is gross working capital another way to say cash flow? If they're different, how so?
That's a good question. You could use that as a surrogate for cash flow, but these are a gross working capital is looking at what's on your balance sheet. You could be looking at cash flow at any time by just looking at basically a cash flow template, looking at money coming in, money going out, and you could be having money coming in from not just operations, but from investing, from finances, etc. And similarly, so yes and no, it's not quite the same thing as looking at cash flow. But if you're looking at cash flow, that's actually far more important than looking at ratios.
What ratios are most important for people in the service industry?
For people in the service industry, what's very important is so let's see, let me just go back. If you're in the service industry, your liquidity ratios are important because you will have liabilities and you will also have assets, current liabilities. Within your ratios, there is a ratio called days sales outstanding, DSO. I have not talked about this, but that's basically it's a calculation of your sales and your receivables on your books. Because when you sell your services on credit, so if you're in the service industry, you could still be you're not probably taking cash. You're probably having people buy things from you on credit, and your days sales outstanding. So most people, when they sell, the invoices say net 210, net 30, or they might say net 30, pay within 30 days. But there are people who will owe you money 60 days out, 90 days out. So if your DSOs are very high, compared to the terms that you're offering in the service business also. This applies even to manufacturing. DSO you should be careful of and not have them become too long. On the other hand, and this might sound a little sneaky, but it's not sneaky, but is your accounts payable, which is on the other side of the balance sheet. You should try to extend out your payments to your vendors as much as you can. If they can be longer, then that's another good ratio to look at. Operating ratios are also very important, and profitability ratios are also important for the service, people in the service business.
Yeah, I see, Seth, that you unmuted. Did you want to add something?
Yeah, sure. Thanks.
Mhm.
I think that Ramesh made a good point, which is to say that these ratios are important in understanding where your business is, both holistically and compared to other businesses in the industry. And in terms of what are the correct ratios for a particular industry, there are resources that where you can look, and they'll tell you RMA collects information on different industries that you can sort of compare yours to. But I think that these ratios are good to just have an understanding of how you're doing in your industry, because a lot of businesses, they have the blinders on. They're just doing their jobs, they're making their product, they're selling their service. They don't know what's happening out there. What they're thinking of is, am I making more money than I'm spending? Like, am I profitable? Do I have enough to pay the bills? And that, as Ramesh alluded to earlier, in terms of liquidity ratios, do you have enough cash to pay the bills, on your statements? But I think that the other thing he said was, really it's profitability ratio. So as a banker, when I'm looking at any business, I always start with a tax return and current financial statements. I just want to see how much net income you've got after all expenses. And once I know that, because mostly people talk to me when they're looking for a loan or they're looking for a line of credit. So I say, okay, get your tax return. How much profit do you have? Can I add back a non-cash item like depreciation? I'm going to add back interest because I'm going to hold that against you later when I determine what your P&I payments are, principal and interest for loans or interest for lines, and how much do you have left over, and is it enough to cover the request of a loan or a line? And the math on that is pretty easy. I think that these preliminary conversations on companies' financial statements more look at profitability and a balance sheet. But if you're thinking long term, which you should be, these are the ratios that are really going to help you plan and be strategic and determine, are you keeping enough money in the company? Are you paying yourself too much? Is that hurting the way your business financials look? And these are conversations for seasoned businesses that are fun. We love having them because it's interesting to see what the business's plan is. I think for a simpler business, and I know we have a mix of different types of businesses on the line, I'm not sure I would spend too much time trying to figure out what my operating ratio is if I'm losing money. If I'm losing money, I got to think about how am I really managing things. So structurally, the basics, are you making more than you're spending because you've got a business that people want, whether it's a service or a product? And if you are, and you've done it for a couple of years, let's talk about how you can elevate it by using ratios to be efficient and strategic in how you're spending.
Great. I do have some more specific questions. We can try and run through these. For the debt to net worth, if you have a 10-year loan, do you use the entire amount due for debt or 1 year's worth of payments?
No, it's the whole amount due for debt, because that's your debt. And assuming that you're on some kind of payment plan or whatever, your loan amount keeps going down. So obviously, if your net worth keeps going up, which will be very good, you'll be able to look at your debt ratios going down. So the whole thing, not just the 1 year thing.
And that's really different in terms of industry. If you have a manufacturing industry or a trucking business where you have a lot of assets, a lot of trucks, a lot of equipment, then you're not gonna want to be any higher than about 4 to 1 on that ratio, 2.5 to 4 to 1, maybe a hair over, depending upon how much new equipment you've got. If you're a service business, you ought to be at 1 to 1 or less because you don't have a lot of debt. It's just short-term debt mixed with short-term assets. So whatever industry you're in will tell you where you should be.
Great. That's a good point, Seth. Thank you. In calculating ROA, is the average assets part of the calculation determination by averaging both fixed and current assets?
It's all your assets. That's right.
Let me see. Can you discuss the cash flow ratio as it pertains to debt to net worth?
Sorry, say that again. What is the question?
Can you discuss cash flow ratio as it pertains to debt to net worth?
Cash flow ratio. That's sort of like it's all citrus fruit, but I think this question is mixing up oranges and lemons.
Okay.
I'm not sure exactly what that question means.
Okay.
Sorry about that. I'm not trying to be
okay.
smart. I just didn't understand the question.
That's
Seth, do you
okay.
have an answer to that? I don't know what.
So I think if someone's asking about debt to net worth, it's a little bit about what we just talked about, which is, how many liabilities do you have? So I've got $100,000 loan. on the business. I've got a $100,000 line of credit. Keep it simple. I have $200,000 in debt. My assets are, I've got $500,000 in cash and $500,000 in trucks and equipment. So your assets is $1 million. Your debt is 200,000, and your equity, what's your business worth? It's your assets minus your liabilities. So $1 million minus 200,000 is 800,000 in equity. So the debt to net worth is a 200,000 to 800,000 is 0.25, which is excellent for any business. So how cash flow affects that? As you bring in sales, your cash goes up, your assets go up, and so your equity goes up relative to that equation. I think that was the gist.
Okay. For a brand new small business, which ratios should you be focused on?
On cash, on your liquidity. That's the most important thing. There's a phrase that I always tell any of the clients who come to SCORE, remember, cash is king. So if you're a new small business, don't focus on ratios, focus on your cash forecast and your cash. Actually, in your own personal life, you should also focus on that.
Okay. We have a question about comparing ratios, and we did touch on that to the peers in your industry. I think we said that already. What is a good, healthy ROA number to use as a guideline?
I think Seth made reference to that. I mean, usually now on the internet, you can also look at your industry and your competitors, or I would say industry and the size of your competition, and just Google it, and you will be able to find out what are the ROAs and the historical performance of the ROA, return on assets.
Okay. And we certainly know that this all can be quite overwhelming. We have SCORE mentors that can help you specifically with your business. So if you wanted to schedule a meeting with one of our SCORE mentors, you can go to the SCORE.org website to do that. You can also email me directly at outreach@scoreboston.org. And I will be including contact information for Robert as well, Robert and Seth. So if you want to reach out directly to the bank, so we will send out a little follow-up email with the link to the recording and information on how to reach if you have any questions for the bank, or if you have any questions for a SCORE mentor. Both of those resources will be in that email follow-up email for you. So I want to thank everyone for joining today. I think a lot of information was covered. Thank you for Ramesh for presenting, and to Seth and Robert and the East Cambridge Savings Bank for their continued support in bringing these very informative workshops to our clients. All right. Thank you, everyone.
Thank you, Teresa. Thanks,
Thank
Seth.
you.
Thanks, Robert.
Bye.
Bye.